Thank you for joining us at xm.com. This is a Forex Preview video. We'll be having a look at the Eurozone CPI coming out this week. I'm Cristina Marujos. With me today is investment analyst Cristina Barcenido. Cristina, soaring inflation has been the main theme in markets across the world in recent months, and the geopolitical crisis with the Ukrainian war adding more pressure on supply chains has only poured fuel onto the inflation fire. On Friday, we will get Eurozone inflation numbers for February, and investors are anticipating another upturn in the percentage. Can another strong inflation print pressure the European Central Bank into changing its stance on monetary policy?
That's right, Christina. Inflation is expected to rise higher for another month, particularly forecast point to a fresh record high of 6.6% year on year, which is significantly higher from 5.9% in February. Well, the driver behind this increase could, of course, be the elevated energy and electricity prices, which have been boosting inflation since last year. However, the core inflation, which excludes volatile energy and food prices, is also expected to increase to 3.3% year on year from 2.9% previously. So that suggests the energy inflation has probably created spillovers to other industries, adding more pressure on household spending. Of course, central banks in the US and the UK have already started to raise interest rates to cool inflation, but the ECB hasn't provided any clear direction on that yet. Some policymakers cautiously admitted that the rate hike could be possible at the end of the year, or used a more hawkish tone to signal a tighter monetary policy in the near future. Although the big uncertainty for everyone is how the war in the Ukraine and the sanction war against Russia will affect the Eurozone's economy. The EU's energy sector, which is strongly dependent on Russian gas supplies and is also a key source of income for Russia, is not involved in the sanction war yet. The EU hasn't imposed any bans yet on that, although it showed interest to reduce dependency on Russian markets and accept more supplies from the US. However, that cannot happen in a short period of time. It would be very difficult for the Eurozone to offset Russia's gas imports in short period. And besides that, the trade disruptions in other sectors and the sanctions imposed on Russian money, as well as the exclusion from the international Russia's exclusion from the international SWIFT payment system could weigh on Eurozone economic activities and therefore press economic growth lower. So whether the ECB will switch to a tighter policy, that will depend on how geopolitics will evolve and whether Eurozone's GDP data will slow down. Now, if another strong inflation print will change the ECB's monetary stance, well, the central bank has already acknowledged in its latest projections report that price growth may further strengthen this year. Perhaps fading effects may result in weaker CPI readings during the second half of this year. But in the meantime, stronger CPI figures will not surprise the central bank. So even though that may add more pressure for higher interest rates, the central bank may adopt a wait-and-see mode until things get more clear on the Ukrainian front.
Now let's have a look at the single currency, because the euro has been at the mercy of the Ukrainian war developments lately. Can a strong inflation print this week offer it some support?
Well, indeed, the euro is very sensitive to any news related to Ukraine. Yesterday, news that Russia may stop some of its military activities in some areas, and expectations that ongoing peace talks may result in some progress, which could let the ground for a meeting between Putin and Zelensky, help the euro to stage an impressive rally. But the rebound is still fragile. The euro dollar particularly is still below 1.1120. That has been a key resistance a few weeks ago. So markets will need more evidence that the two sides have already an agreement in the coming sessions before becoming more confident on the euro. So all the attention will be on Ukraine, and probably Eurozone CPI inflation data could be a weaker market driver for the euro, at least for now. Also, the rate hike pricing in futures markets is already too aggressive, and another strong CPI report may not make any difference here. Investors price 65 basis points of monetary tightening, that is 10 basis points rate hikes for this year and imply one rate hike for each meeting, which currently doesn't look realistic. So overall, I think Eurozone CPI data may not affect the euro much, or at least could have a short-lived impact. Some Eurozone countries, such as Spain, have already reported very strong inflation prints, which were way above what analysts expected. Particularly, Spain has reported a 9.8% inflation year on year, which is quite strong. So that has probably provided some direction to investors about what to expect from the block CPI data on Friday, and Eurozone's data may not bring any new information to the euro.
Christina, thank you for joining me today, and thank you for watching this Forex preview here at xm.com.